So today we're not going to learn anything new, which is good for you guys, right? Because who's already feeling a bit snowed under and overwhelmed and scared for the exam? Okay, all right. So today we're actually going to do a recap week, which is a recap of all the topics, the practical application topics that we've done until now. And we're going to be using Learning Catalyst as well. So today we're going to do a number of different things, and these are all things that we've done before, but we're going to go back over some of these. So we're going to go back to inherent risks. We're going to look at internal controls again. We're going to go to audit strategy and the audit risk model again. We're going to look at materiality, key considerations when we're designing audit tests, testing controls, which I'm going to do a mini little demo of, and then I'm going to leave you an exercise to do online if you want to practice. And we don't really need to go back over these for substantive tests because we did that all last week. Hands up who's seen the video about executing substantive tests. Was the video useful in doing the quiz this week? Yes. So if you haven't seen the video yet and you have your quiz coming up, I would strongly recommend watching it. All right, so that's a key tip. All right. So can anyone tell me, shh, I know we're all really excited, all right, because, we're getting towards the end. Shh. What standard requires us to understand the client? Anyone know what ASA? 315, excellent. So ASA 315 says we need to understand the client, and let me just, hang on a second. Oh, no, what am I doing? Oh, all right. Okay, so all of these were correct. Why is it important to understand the client? A, the auditing standards do require us to do so. So that is a legally responsible thing to do. B, it allows us to identify areas where the risk may be the greatest. Because we're trying to take a risk-based approach to audit. We don't audit every section the same. C, to allow the auditor to conduct a more efficient and effective audit. We're searching for areas where they're more likely. And then D, to allow the auditor to implement the audit risk model and decide on an appropriate audit strategy. All right, so all of those were reasons why we had to look at the risks of the client. Okay, so next question that's about to pop up that you should be able to see on your device right now says, which of these statements is true about inherent risk? Many choice, again. A, the inherent risk factor the inherent risk is a factor that increases the risk of an account or assertion for an account being misstated. B, an inherent risk does not have to be linked to a specific account. C, can be caused by increased complexity or increased use of estimates. D, being in a competitive industry is an inherent risk. And E, inherent risks are caused by management. Pick the ones that are correct. And again, many choice. So let's look at our results. See if I can make this a bit smaller. Here we go. Oh, no, it keeps resetting itself. Oh, no, way too big. Okay. So which of these statements is true? A, yes, an inherent risk is a factor that increases the risk of an account or assertion being misstated. B is incorrect. So we must be able to, for any inherent risk, be able to link it to a specific account. We must be able to say that this risk, and you'll be able to review these as well on Learning Catalytics, so you don't have to stress about trying to write down the right answers. So it does have to be linked to an account and assertion. You have to say something very specific. C is correct. It can be caused by increased complexity and increased use of estimates, which is in ASA 315 in the appendices. D, being in a competitive industry is not an inherent risk on its own. All right? The university sector is an extremely competitive industry. However, there is no incentive for me to manipulate any of your results being in a competitive market. All right? So there has to be, for part D, something else that encourages managers to manipulate. Now, that something else could be management incentives or bonuses or executive stock options that might align their interests with performance of the firm, but just being in a competitive industry on its own is not enough to create an inherent risk. There has to be something else driving it. And then E, caused by management, not really. For the fact that, management choose a company in a particular industry, they can't really do anything about that. All right, so now what we have, let's go to my next question. And this is a short answer, so there's no actual specifics here. Oh, it comes up really tiny on the screen. Describe in one sentence an inherent risk at IKEA. That says IKEA in really tiny. I tried to make it fancy by doing it in a different colour, but it's obviously just mucked up on me. Do not explain why it is a risk, just name and describe the risk. Okay, so and there's no correct, this is not a marking thing, and none of this today is being assessed, but we're going to use this to generate some discussion. So see if you can think of an idea of something that could be an inherent risk at IKEA. Does everybody know what IKEA is, by the way? Big blue store with the yellow sign number, known for the Swedish meatballs and mashed potato and the flat pack everything. I always go into IKEA with the intention of only buying one thing, and then you come out with a whole lot of other stuff you never knew you needed because of the layout of IKEA, that maze that you have to walk through. My philosophy at IKEA is if you see it, grab it right there because you won't be able to backtrack to find where you found that little product again. So I always end up with more stuff. All right, we'll give it till 2 minutes, and then we're actually going to analyse some of the responses. All right, so let's have a look at some of these issues that are going to be certainly inherent risks at IKEA. And the ones that I'll highlight green are certainly the ones that I agree with. So valuation of inventory purchased from overseas suppliers in different foreign currencies. Absolutely something to consider, right? They don't manufacture much that's local. So thinking about foreign currency translation reserve is definitely going to be an issue for IKEA. The next one we have there is theft. Certainly, theft would be a big thing at IKEA because there's lots of small little items, and there are hundreds of items that probably don't have one of those little store RFID tags on them, so that's certainly something. I'm not sure what S is supposed to be. Maybe someone started typing something, got confused there. Now, the next one, we need to be really careful. So something is going to impact the revenue account, but you need to say what it is that's going to impact the revenue account. So for that one, I'm going to put a little line through because that's not really what we're after. PPE risk. Again, PPE risk needs more detail. So when you're answering this sort of question in the exam, something like up here is quite ideal because we've got detailed information about the item and how it creates a risk. All right, so PPE risk, probably not quite enough detail. So I'm going to cross that out because that's not quite suitable. All right, now if you're the author of one of these ones I cross out, learn from the fact that we go, this is where I'm going wrong. This is where I need to make an improvement in an exam situation because I want you to be able to make mistakes right here, right now with me. Where don't you want to make a mistake? In the exam. All right, so better you make mistakes now than in the exam. The next one, people may steal something. All right, which is the theft one, definitely, that's theft. On-floor sales managers may attempt to inflate sales for bonuses. I would say that if that was true, if there are bonuses, does anybody work at IKEA? No? Oh, that's a shame. We'd be able to get some inside knowledge there. But if there were bonuses for making sales, then certainly there might be that risk. Now, for most people that work in IKEA, do they work in specific departments, or do they sort of roam around? There are only a few areas where people need specialised knowledge, and that would be kitchens, where they're doing all their kitchen design type stuff, and bathrooms, where they do that sort of bathroom design creation using the computer, etc. So in those areas where you have the opportunity to upsell a little bit more, or you might want to buy this dishwasher, or you're going for a laminate benchtop, what about stone? That'll look nicer, it'll last longer, and it's 20% off. Those are the sorts of areas where I'd probably expect to see salespeople have a bit more of an incentive to manipulate the accounts. Just like at JB Hi-Fi, the guy who is helping you in the DVD area isn't getting excess commission on how many DVDs are sold, but the person who sells big screen TVs is more likely to be on a commission. Okay, next one, not being able to estimate contingent liabilities for workplace injuries and lawsuits. I would say that's definitely something to consider. All right, and that would be the same for any business. Meeting sales targets. Now, I'm going to put sort of a question mark next to that one. Because that one you need to have proof of some sort of incentive scheme. All right, so to be able to say something about meeting targets, there needs to be an incentive scheme. And again, the same down here. Management pressure to reach a sales target while operating in a competitive industry, as long as there is some sort of incentive scheme and their performance, their bonuses are tied to performance, then certainly you could go with that one. So I'm going to put that one in yellow because that's sort of, orange, because that's conditional on there being an incentive scheme in place. All right. So you'd need to look through and find out if something was there. Labour management is a bit vague. I probably wouldn't have that one there, unless you've got to be a bit more specific. Inventory turnover is our next one. Being able to clear out stock, otherwise having a lot of excess stock. So this would be sort of related to, and what I would be looking for here, for a bit more clarity, to give it more oomph so that you have impact in the exam and I can say, yes, this is definitely an inherent risk. Why do we want to identify low turnover inventory? What's the risk? You might not be able to sell it because it's obsolete. All right, so using keywords like the risk of obsolete stock is more likely to give you a bit better impact there with that inventory turnover one. All right. Certainly if there's a risk of obsolete inventory, we would use inventory turnover as the analytical procedure to help us identify the issue, but I wouldn't phrase it as the way of inventory turnover. So you want to make sure, so that's a bit of an orange one there. Good, but could have some improvement. All right, I've got the same one up here twice. Those are repeats. All right, again, inventory turnover we've seen already. Inventory stolen, we've seen that one's okay. Now, I like this next one here. Risk of miscalculation. I'm guessing that this relates specifically to inventory valuation methods. All right. And what subject did we learn about inventory valuation methods in? CMS. And we know that inventory valuation, what goes into the cost of inventory items? Product cost equals, oh gosh, David Bedford would be very upset to hear that you can't remember this. Direct materials, direct labour and overhead. Now, which of these parts do you think is going to be most complicated to calculate? The materials, the labour, or the overhead? The overhead, yeah, absolutely. So the overhead is the bit where we're going to have the most questions. Are they using activity-based costing? Are they using departmental or plant-wide? So for a company that makes flat pack everything, Figuring out direct materials and direct labour is probably easy, but figuring out the overhead is going to be quite the difficult part. Okay, let's see here. Inventory, a bit bland, again, not enough information. IKEA selling seasonal stock such as Christmas-styled furniture or decorations outside of their respective seasons. Now, I would probably class that one as a business risk, all right? If you don't sell all your Christmas stock, then it has to be either stored somewhere or you have to throw it away. They'll probably store it. I can't imagine they're going to throw away a whole lot of inventory they could sell next year. But that's not necessarily going to increase the risk that Christmas stock is going to be incorrectly valued. All right, reindeer napkin holders are going to sell this year as much as they're going to sell next year and the year after, because we're always after the same sort of themed stuff. So I would say that that one there is definitely way more of the business risk. High levels of inventory, I'm going to put that as a maybe if we link that one sort of back to the risk of obsolete inventory, potentially. This next one's interesting. High levels of estimates on sales. Would they be making many sales that require estimates? Probably not. Right? You buy a good, there's no buying on credit, you just scan it at the checkout and it goes. So I'm not sure there what sort of estimates there would be, but I wouldn't really think that that estimate one is going to be really important. Foreign exchange reserve we've already looked at, and we said that one was great because there's discrepancies in foreign exchange rates. And then earnings management, again, for earnings management, I'm going to put in the orange category, as long as we link our earnings management to an incentive scheme or some other factor that leads the company to manipulate. Now that could be an incentive scheme. It could be taxes. If you do some Google searching on IKEA and taxes, there's lots of information about how much tax IKEA does and doesn't pay through transfer pricing. All right. So we've got a pretty good list. Is it a little bit more clear to everybody now how we design and identify an inherent risk, looking at a whole lot of different examples? Yes? Hopefully yes. All right. Okay, so what do high, medium, and low inherent risk firms look like? So we're going to talk about some common characteristics of things that we might see. So low risk firms typically are in firms or industries with low or slow rates of innovation. All right, so low or slow rates of innovation. Often we also see low reliance on advanced technology. Okay, because when you're relying a little bit less on advanced technology, things can move a little bit slower. So industries that have changed little. So custom furniture, for example, making baked beans, making Tim Tams. I don't think the method for making Tim Tams has changed much in the last few years. So examples of that have relatively low inherent risk could be places like, I always use the ramen noodle manufacturers, because ramen noodles really haven't changed much since I was a kid. I'm pretty sure my dad still buys the same brand from more than 30 years ago. And I think the packet has shrunk a little bit. You get a little bit less noodle for the same price now. But otherwise, the product is exactly the same. Flavor sachet is the same. The design is the same. So that'd be something low risk. What would be a high risk type of industry? A high risk type industry? Anyone want to take a guess? Pharmaceuticals, yes. So high industries are like pharmaceuticals, if I can spell, pharmaceuticals. What other sorts of companies? IT, yes. Mining. The other one I would think of that immediately springs to mind, airlines And the other one I'm going to say is financial services firms. The reason I say financial services firms is because the requirements under IFRS 9 are really, really complicated. So high-risk firms tend to be in industries that change rapidly and that require R&D to ensure sales. All right? So the industries that change rapidly, industries that are open or require a lot of estimation. Estimation in the accounting. All right. Are the sorts of industries that often are in that high risk. And then our medium are somewhere in the middle. All right. So places that I would put into the medium type of risk, things like McDonald's. Why do I put McDonald's in a medium risk rather than in a low risk? Because, you know, they're still selling chicken nuggets. It's the same chicken nuggets that we've been eating for a while. Well, not actually the same, obviously fresh chicken nuggets, but the recipe hasn't changed much. But what is McDonald's doing across Australia that you may have noticed? There's lots of health initiatives, but something else, something that they're spending a lot of money on. Rebranding, and they're involved at the moment in a lot of redevelopment. So McDonald's stores looked pretty much the same for a really long period of time. Now we're seeing the McCafe side, you know, revamping. In my area, so I live out near Blacktown, almost every McDonald's I can think of, so there's 6 McDonald's probably within a 15-minute drive of where I live. And every single one of those has had a complete renovation where the store has been closed for a number of days. They've redone kitchens, dining rooms, McCafe, drive-thrus, kids' playgrounds. Now for me, that's more risk because there is now more property, plant and equipment and fixed assets to worry about valuation for. And the complexity of that would make something like McDonald's quite complicated. So how do we measure free from material misstatements and true and fair? Because we know that truth is certainly, when we use the word truth, the idea is that a lot of it is about perception. And I use the example of Kanye and Taylor Swift, and obviously Taylor Swift, and I didn't realize it was that long ago, but it was back in 2009 when Taylor Swift won her VMA for Best Music Video, and Kanye stormed the stage and said, "Taylor, I'm gonna let you finish, but Beyonce's video was the best video of all time," and that was his perception. All right? Obviously, I don't know if anybody watched any of the most recent Kanye West fashion show, the Yeezy fashion show, where the models looked a bit miserable and they had shoes that they couldn't walk in. And I personally didn't like it. But some people were saying, that's fabulous, this is fabulous fashion. And other people are saying, who is actually going to wear any of this stuff? So a lot of times, truth is perception. But I cannot go to the numbers and say, look, are you true or not? So instead, I use my assertions as my characteristics of truth. All right? And you might notice that assertions have come up in our quizzes almost every single week. So assertions have come up every single week because they're critical to doing the audit. If I don't know what assertion I'm testing, what evidence I'm gathering my assertion for, what assertion I'm gathering my evidence for, then I can't design the procedure. If I can't design the procedure, I can't execute the method to collect evidence, and I can't generate my opinion. So this is really, really, really critical. All right, now we have some more learning catalytics exercises. Hang on a second. It's a bit like being Keanu Reeves in The Matrix. Who's seen The Matrix? Have we all seen The Matrix? If you haven't seen The Matrix, this is a movie you should go and see. So when you become an auditor, suddenly the world becomes not just the world. Now you perceive risk. and you see internal controls, and you see control weaknesses, and you see places or documents that you could use to collect evidence. So hopefully here, I'll give you a few more seconds, and then we will check what everybody has said. And I want that for you guys too, right? To do well on the final exam, even if for the next 4 weeks, immerse yourself in auditing, all right? So take that mindset of what can I see when I look around in relation to audit. Excellent. So everybody has their dot on the right place. What does that little tag do? It beeps. All right, so let's move on to the next question. Okay, here's Audit Junior in the same store. Place a mark on the internal control. You might see there he's got a Paw Patrol backpack on. We went to the Paw Patrol live show. If anyone has nieces or nephews, they'll understand the appeal of talking dogs. All right. So, I'm not sure what this spot out in the middle is out here. She is not an internal control. If there was a security guard, if she was the security guard, potentially. And unfortunately, Audit Junior is not also the internal control there. But what are these big things? Now, they have advertising on them. I think they had advertising for some football star or something on there. But what are those big black things? They're the scanners that link with the tag from the previous instance, where if you walk out past these, it'll go beep, 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 and hopefully someone will chase you. So RFID tags are a great way to control inventory. You see them not only in sporting goods stores, and you saw it on a hoodie. There was no RFID tag on my son's kickboard that we bought, but that was only a cheap $10 thing. So on high-value items, you'll often see RFID tags. Some supermarkets that have a history of theft are now putting RFID tags on meat, expensive meat products. So not your $5 mince, but your $30 or $40 Scotch fillet or eye fillet steak. They're putting these little tags on because they're finding they're high-risk items. So how do we identify control weaknesses? And this is really important because obviously weaknesses, oops, I can't spell, allow us to target our substantive testing. All right, and it gives us somewhere specific to look. And that makes our audit more efficient. And if I can do my audit more efficiently with less effort, then that means my partner will make more profit. And when my partner makes more profit, hopefully my audit firm partner is happier. And when hopefully audit firm partners are happier, then they're more likely to give us a bonus. All right. So there are 3 different methods. Number 1, the observation. That only works, of course, if people don't really know you're watching. Obviously, just like when you're in the exam, when the exam supervisor walks past you a lot, you get really nervous, really subconscious. So observation is good, but people change their behavior while they're being observed. The assertion method. So that's when we write down all the assertions and say, is there a control for each assertion? And that's theoretically anywhere there's assertion without a control, that could be an issue. Or the what sort of bad things could happen method, where you think up every single possibility that could go wrong. Oh, we charge someone the wrong price. Oh, we send them the wrong goods. We deliver it to the wrong address. We accidentally invoice them twice. You come up with every bad thing that could happen, and then you try and figure out, is there a control to prevent charging them the wrong price? Is there a control to prevent sending them the wrong goods? So we sort of do a combination of all of these 3 things. We start with observing to find out what happens. We draw our flowchart and we say, oh, look, are there any assertions without controls? And then we sort of might also say, oh, look, is there anything else I could think of that should have a control? So those are our ways that we identify weaknesses. But for students, observation is often a nice, easy one. Anytime I go to a restaurant that says cash only, I automatically think, oh, poor controls over cash. The company's more likely to be understating revenue because they're trying to maximize illegal takings. All right, so always keep an eye out. Okay, so my next question, what controls, and again, this is just a free-form little text one here, describe a weakness that could be an issue at self-serve checkouts like we see at Coles, Woolworths, and Big W. And I posted an article about this the other day, where Coles thinks that they're actually trying to clamp down a little bit. And based on the comments on that article I think I posted about Coles, a lot of students didn't even realise that they could do illegal, fraudulent things at the self-serve checkout. That must mean that we're all very ethical, which is good. So if we look at our list, all these different things that could go wrong. We could select fruit and vegetables and select a cheaper item, a cheaper version of it. Weigh the wrong products in order to reduce the price. I'd never even thought of that. Theft without payment because the self-serve checkouts outnumber the one person that's monitoring. That's absolutely true. There's obviously risk of theft. Some items or products don't have barcodes, so you could type in the wrong thing. Selecting different products based on the weight. Screening an East African aubergine instead of a Spanish pineapple. I didn't know there were such things as East African aubergines and Spanish pineapples. What sort of Woolworths and supermarket? There's none of this at Blacktown. Just saying. Scanning onions instead of avocados. Yeah, because avocados are expensive. They reckon it's all the hipsters that's driving up the price of avocados. A potato instead of an avocado. They enter the wrong type of vegetable. That's my husband. He just picks the vegetable that looks closest, even though it might be the wrong one. He's a bit terrible there. Take advantage of the weights by putting less items on there. The fruit and veggie one. Not scanning all the items. No theft alarm for products like fruit and veggie. Oh, look, that's happened to me by accident before. You know, my son's taken a banana and then he's carrying it throughout the entire store, and then he walks out with it. I'm like, we didn't pay for that. And he goes, oh, well, you know, he's already half eaten it. How do I go back? And I don't know what to do. Do I weigh like half the eaten banana and pay for just that bit? I always get confused there, so I always buy like a bunch, weigh that extra one. Passing off bakery items, croissants as bread rolls. People can hold their bag of fruit up to reduce the weight registered. Just a little bit to reduce the weight. Double scanning or not scanning items. The discounted price might not be updated. That happens to me a lot. You know, something is not the price it says on the sticker. We talked about the manually entered ones. You could scan an item twice by accident. Yep, I've done that. Especially when you've got a 4-year-old trying to scan the item and it goes bip, bip, and you're like, whoa, hang on, we didn't buy 2 of those. Some stores are not equipped to take the new $5 notes. Absolutely, I posted about that. And the one supervisor we've talked about. Wow, you guys have some pretty good ideas here. Should I warn Woolworths and Coles around you? Watch out for these students. Okay, so what do high, medium, and low control risk firms look like? So low control risk firms tend to have good internal controls, procedures, and a culture that supports doing the right thing. So even if you end up with a situation where there might be a missing policy or procedure, what's going on with my keyboard? So even if you don't have a policy and procedure, if your staff are all about honesty, they'll figure out the best way to do something. So good policies and procedures, and we're looking for small or minor deviations or minor weaknesses, all right, that are unlikely to have big impacts on the financials, okay? High companies are pretty much the opposite. So poor policies or lack of policies and procedures. All right, often there'll be harsh work environments where people are not willing to do the right thing, or people feel so under pressure by their boss that like, oh, why should I follow the policies and procedures because you're just a tyrant and a bastard and I'm just going to stick it to you. So harsh work environments, rapidly changing environments, often when they can't keep up. So the internal controls might not be able to keep up with the change. And then medium is going to be, medium's going to be in between there, okay? So if you had to think about it from a number perspective, because students are always asking me, what's the number perspective? You know, this is sort of like your 1 to 2 misstatements, and this is going to be your 5+, and this will sort of be, you know, your 3 to 4 weaknesses or errors. Now, obviously, in some firms like BHP, you're going to find over the entire firm more than 5 of these, but this is sort of like per transaction cycle type of area. All right, using the audit risk model to determine audit strategy, we know what the audit risk model looks like, and most people seem to have an understanding of it from the video interviews. What audit risk level would be most recommended for a partner to set? Low, medium, or high? Low. Low risk of getting sued. You'd be a pretty silly partner to set it anywhere else. So when inherent risk is low and control risk is low, detection risk is? Detection risk is? High. Phew. All right. When inherent risk and control risk are high, detection risk is? Low. And when inherent risk and control risk are both medium, detection risk is? Medium. All right. Now, if you ever get stuck with what it's supposed to be, start with the matrix and then work out like this. Medium along this diagonal. Then everything on this side is still low. All right, low, low. Everything here is, you could say high. High. Now, if you wanted to be really picky, you could say here, detection risk will be highest, and this will be lowest, all right? But where you've got high inherent risk and medium control risk, you're better off going safe for a substantive audit, all right? So you're better off being a little bit conservative. So, detection risk, low detection risk substantive approach, high detection risk a controls approach, but remember you still do some substantive testing here. You don't ever get away with no substantive testing. All right, what auditing standard covers materiality? 320. Oh, who was that? Up there. Bonus points. That person should come see me after the lecture. I'll give you a prize. All right, so what is materiality? Materiality is some level or factor of items that we think are important enough to adjust. All right? Now, remember the idea of materiality is also relative. All right? So 200,000 for a medium-sized firm. At somewhere like BHP, it could be $10 million or $12 million. And materiality also comes in 2 different formats. We look at quantitative and we look at qualitative materiality. All right? Quantitative is the numbers, and qualitative are things that might be important because of their characteristics, but not necessarily a big number item. So things that could be qualitatively material include things like executive compensation, fraud, related party transactions. They might not be large in dollar value, but they're important because they reflect important decisions that might be made in the firm. So how do we calculate it? We select a number that represents a key driver of the business, and then we multiply it by a percentage. Okay, so our next question, hopefully you'll see the actual little question in your little view there. Out of the following potential numbers to base materiality calculations on, match the materiality option with the type of firm that would be most suitable. All right, so if we think there are increased misstatements or if we think we find one of our fraud red flags. All right, so if we see something like that, then we're likely to decrease our materiality. That increases the possibility of the misstatements that we might find. If you haven't seen it yet, there is a video on risk and materiality on YouTube. It's the one that has the little beaker shape diagram and some X's and some levels in it. If you're looking at that one, that's the right one. All right, 4 rules. I'm going to keep going over the 4 rules between now and the end of term because this is really critical. And it's the reason why we did a practice of the 4 rules today in the class. Use the right terminology. Use the client-specific information that may come from your case materials. Be specific and detailed, really, really important. And then make sure that the procedure you're doing matches the right item. All right, which controls do I test when I'm testing internal controls? Especially when a company may have 20 or 30 or 40 controls in a process, what we're looking for is the key controls. So which ones do the most to prevent or detect a material misstatement? Which is the control that best ensures completeness for transactions? Which control is the best to make sure that their transactions are accurately recorded? And we might test 1 or 2 of those. With substantive testing, always start with the assertions, all right? Because that way you will never forget to write a test. Students who just start writing tests without thinking, what assertion do I need, might end up missing one. You might write tests for 3 assertions instead of 5. So always start with the assertions. But sometimes some assertions are at greater risk than others, all right? For those, we may write more than one audit procedure. That will allow us to corroborate or triangulate our audit findings. All right, so that means if you think, oh, I'm going to use some internal information, I don't know if that's really great evidence for a high risk assertion, I might get some external evidence as well. How much evidence do you need? Well, Michael Jackson once said, don't stop till you get enough. I'm not sure he was specifically referring to audit evidence, but whenever I hear that song, I think about the idea sufficient and appropriate evidence. And certainly, you want to make sure that you feel like you have enough to be able to say, yes, I think this is the true and fair value for the account. Now remember, haphazard is our most common method, and random is suitable if you can test a large number of items over the computer, or, I should have added this, or via outsourcing. And that means, especially for a lot of Australian firms, scanning the 500 sets of documents and then sending them to the Philippines or to India, where auditors over there do all of the ticking and checking that you guys did in the demonstration last week, and for a lot less price as well. So you might be able to do random if you can get somebody cheap to do it. What you do not need to know, I'm just emphasizing this again, how to calculate sample sizes. Not something that's it's in the textbook, but not something I'm requiring you to do for the exam. All right, these come from ASA 530 Appendix 2. And these are two different tables or excerpts of tables that talk about when I want to collect more or less evidence. All right, and so these are important. I want you to know, oh, I want to collect more here, I want to collect less here, but you don't need to know sizes. Okay, so if you want to have increased reliance on increased use of controls testing, then you're going to collect more sample sizes. All right, so that's the key one there for tester controls. If for substantive testing, I want to use more than one procedure, using another substantive procedure, then I can actually collect less. So instead of collecting 100 from one item, I might collect 40 from one and 40 from somewhere else to get a smaller overall sample. Substantive ones have a bigger risk here. If we have we want to have an increased level of assurance, then I collect more. If I'm going to raise my materiality, I collect less. If I'm going to stratify my population, I collect less. All right, so the key here is that the sample sizes from the strata are generally less than sample sizes if we used the entire population as one big group. Now, number 7 is the one that probably creates the most issues. So the number of sampling units. Let's say I went from 5 million transactions to 7 million transactions in a year. Under statistical sample size collection calculations, the size on the sample would not be, the increase would not be to the same proportion. All right, so you might think, oh, if I double my sample size, if I double my population, shouldn't my sample size double? No, it only increases by 1 or 2 transactions. Now, that becomes a little bit different if you go from 20 transactions to 250, then you're likely to see mathematically or statistically bigger increase as a percentage than over here. All right, executing tests of controls. Remember here, this is just like what I did in the case. I put my initials down, I put today's date down, which is the 6th of the 10th. All right, I've just given you an excerpt. I'll give you the full case for you to do. But the first test says for orders over 5,000, check for the manager's signature. Now, when we blow this up, we'll notice that there are a number of areas where the manager's signature is missing. It's missing there and there and there, but it seems to be present there. Now, in the case that you'll get, it'll actually say that for orders less than $5,000, we don't need to have a signature. So even though that's missing an issue there, it's not a problem because the order is less than 5,000. So there I'm going to use my little tick mark. I'm going to say, yep, that's fine. A, that's fine, and that's fine. All right. I'll do a full demo workup of the controls testing one, but I'll give you the full sample exercise on UTS Online to work through. All right, and then I put the details in. I say manager's approval, yes, 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 yes. Now, the only thing that's different is that materiality is now set in terms of deviation. So if there's more than 2 issues in which the control doesn't work, then what I'm going to do is I'm going to want to increase my control risk assessment, which will then result in a change in detection risk and a change in audit strategy. All right, substantive testing we've done. So we have done all of this. ASA 315, understand the client and assess risk. Design my audit strategy and audit program to be able to collect evidence for ASA 500. We've evaluated the results and the misstatements, which comes out of ASA 540. All that is left for next week, I forgot an internal control question. That's all right, that's no worries. But all that's left for next week is negotiating adjustments and finalising the audit, which will run from ASA 560 and 570. All right, negotiating the adjustments doesn't come really anywhere. It's a little bit of ASA 540, but it's a lot of psych theory. And the audit report, which is going to be 700, 701, 705, and 706. Now, before we rush out today, I would like to hear everybody's thoughts about this style of lecture where we're doing more and less just sort of basic listening. So I'd love to know what your thoughts were today about whether you would like to see more of this or less of this. And this will help us in planning for next year. And then once you've filled in that one, I'll set another question up as well that has any other comments. So thank you very much for this week. Keep an eye out for the controls testing exercise on UTS Online, and then there'll be a video accompanying that works through the solution.